I filled up over Christmas with the petrol and I felt really quite good.
It's funny, isn't it? It's funny how much of a good feeling it gives people. Because I'd say, so for example, you're filling up a car, you've probably maybe had a fifth knocked off the price of that compared to, you know, in summer, the middle of summer. Now, most people aren't spending that much money on petrol every month. So, but even if they're spending, say, 150 quid or something like that, they may be saving 30 quid now compared to before. Now, there's not a huge amount of money, but it is that kind of thing that makes people feel better in the pocket. And I spoke about this when I came in before Christmas as well, this idea that actually a little bit of, you know, low inflation or deflation, I don't think is a bad thing for the UK consumer, and actually probably for consumers around the world, who, to be honest, you know, have faced inflation over recent years, and now they could probably do with a bit of lower prices, lower energy bills, lower petrol costs. No, that's all going to feed through into a little bit more confidence.
So obviously if you live in China, if you live in India, if you live in the UK, America, we're happy. Obviously Venezuela, Nigeria, where else? There's a couple of other sort of countries that are going to be in trouble. What, in terms of the markets in the last couple of days, okay, you know, is it all about Greece, or is this about the falling oil price, or is this about uncertainty? Is this about interest rates? Is this about, or don't we really understand?
I think it's about all of it, really, isn't it? I mean, I think that what you've got is nobody expected the oil price to fall this fast. I mean, it's more than halved over the past year. And, I mean, that has destabilised markets. I think ultimately it's probably going to be a good thing for the consumer, but I think there's possibly a bit of a hidden danger in here that most people don't think about.
Right, and what's that hidden danger?
I think this may potentially be the thing that actually derails the bond markets.
Okay.
In terms of, you've got junk bonds, high yield bonds, which have been driven up, the price has been driven up, the yields have been driven down over the years.
Yep.
There's been a lot of issuance, companies taking up the opportunity to borrow money at low rates. And there's been a lot of investors, institutional investors particularly, who probably haven't been paying enough attention in this low rate environment as to how much money they're lending to people, at what rates. You've also got investors buying into this. And those US oil and shale companies will have done their maths for success on a much higher oil price than we've got now.
Okay.
I would think that even with some of the major companies, their worst case scenarios didn't look like the oil price being this low. And if there's a wave of defaults amongst those, you know, high yield bonds, then it could have a knock-on effect and it could be enough to sink the markets. And I don't necessarily think that this is definitely going to happen, but I do think that investors, ordinary investors, need to be aware of this.
Right. So if you are an investor, because you represent the public and you're looking for money saving schemes invariably, 2015, you know, I see that some of the banks are calling the FTSE year-end 7,000. Citibank are calling it 7,700. Okay, that all sounds very toppy to me.
Oh, it does, with the market down like it has been yesterday, today.
Down 2% yesterday,
yeah.
sort of.
But I think that, so there's two things coming into play here. I mean, if you are a long-term investor, and from This Is Money standpoint, we're talking to long-term investors, buy and hold investors, because whilst I just don't think that most people have the time or the inclination or the discipline to stick to a trading strategy and tweak it and come up with it and stick to that. If you are a long-term investor, then I think you need to be thinking about a couple of things. That there is this risk there is opportunity, but there's also risk. But I think you need to be looking for things like value and quality and avoiding anything that's overpriced or overly speculative. Because if the markets do take a real tumble and a prolonged tumble, everything's going to get hit. But you can guarantee that what will happen is that overpriced stuff and that speculative stuff will get hit much harder.
Yep.
So, I mean, you guys had Tim Price on as well before Christmas, and he was talking about value and how value tends to overperform over time. And there's a wealth of studies that look at this. And if you can mix looking for value, companies with strong balance sheets that don't look expensive, with some quality, then you're setting yourself up for a better chance of success over the long term, I think.
Well, I looked at sort of 2014. Now, in terms of the worst performing stocks in the FTSE, Tullow was down 52%, Tesco's was down 43%. Now, I would have thought Tesco's a world-class name, and you've still lost 40% of your money.
Well, absolutely, and I think that this is where, for people picking individual shares, it becomes quite difficult, because people will look at Tesco and go, Tesco, good company, strong company. But I think that if a year ago you had drilled down into that balance sheet, there probably were some warning signs that said to you, maybe this isn't so good. And if you put it into the bigger picture of, it was already struggling, there was the discounters eating into it, and then once you started to see food prices falling, a massive retailer like that is a low margin business and requires a huge amount of volume is going to get hit when those sales start falling. I mean, it's very difficult to pick those individual shares. So for a lot of our readers and a lot of long-term investors out there, they'll be looking for funds or investment trusts or even trackers and ETFs. And I think, again, what you need to be looking for perhaps for the year ahead when you're looking at things like that is listening to what that fund manager or that investment trust manager is saying or where that ETF or tracker's looking, and be looking for those words, value, quality, for people who are a bit discerning in what they're investing in, because I don't think this is going to be the year to just chuck money at the markets.
Right, so a stock picker's market.
Yeah.
In terms of oil and deflation, obviously, this inflation, this headline seems to be disappearing by the day. What's the impact is that going to have on the actual equity markets? And in terms of the currencies, do you follow the currencies?
We do follow the currencies, and I mean, certainly the one that preoccupies our readers is what's happening with the pound versus the euro, the pound versus the dollar.
Yeah.
And to be perfectly honest, for most people, what they're thinking about is how much it's going to cost me when I go on holiday.
Yeah.
Now, obviously, the euro is doing very badly at the moment against the dollar. It's not done as badly against the pound. But we saw the problem earlier last year of the strong pound, and that started to hamper, the economy in terms of exports and manufacturing. And actually, we don't want the pound to be too strong against any of those currencies.
Yeah.
I think that currency is probably going to be a big issue this year. I mean, look at the ruble and how much that's collapsed by. If Russia's got debts that it's got to pay in dollars and it earns its money and it's earning money in rubles, paying those debts becomes a lot harder. I mean, currency is obviously far more important from a trading perspective, isn't it? And I mean, you come from a trading background.
Yeah.
When you look at the markets right now and looking at them 6 months ahead, what do you think?
I sit in with some very clever foreign exchange people, and they've all been very consistent in terms of the dollar is going to continue to strengthen. This is the beginning of the trend, not the end of the trend. And again, that would be a theme. The only flip side is that when you get too much of a crowded trade, it invariably goes the other way. But I think euro dollar has broken through a 9-year chart level this weekend, and on the back of that, this 115 level, people are talking about year ends. We had a head of trading on first thing this morning on the trading segment saying, well, I think it's going to go further. And the fact that this guy's called it so well for the last 6 months, my money is with him.
Yeah.
Now, what does that actually mean for the euro? I'm suggesting, this printing's going to happen. Again, we had an economist on earlier. He's saying it probably won't start in January or February. He's looking March, April. And he's saying that actually, if you go to school now and learn your economics, okay, it's out the window because this is all about central banks and, the game is different. And that really worries me when the game's different, okay. I don't understand some of what's going on at the moment.
Well, I think, and that's the thing, we're nearly 7 years into a 0.5% base rate. We're a long way into that low interest rate scenario, and that hugely distorts markets and what goes on. And there's a lot of money rushing around the world, going from place to place, and you see this rush into what's doing well and this rush back out into safe assets. I mean, last year, you look at the figures, and gilts did, they were in the top 5 performing, fund asset classes in the UK. Well, everybody said that UK government debt was going to sink last year because interest rates were going to go up, and there was no way that they could get any more highly priced than they were. So, as you say, I think that groupthink and that consensus thinking, it pays also for investors to question that. And I would maybe even question what people are saying about the oil price. Everybody is now expecting the oil price to sink below 50 and stay down below 50, maybe even go down to 30. What if it bounces back up? The
art of contrarian thinking. Well, I was just the last point I was going to make is interest rates. I remember, one of the bookmakers was, raising headlines. Would interest rates go up before the general election or just after the general election? I don't think they're going to go up this year.
I don't think they will. I mean, you look at what's going on. I think that they're an emergency measure, and we're probably, the Bank of England looks at it as that we're still in an emergency. The Greece situation is serious. The Eurozone situation is serious. The oil price has fallen, which is bringing down inflation. The Bank of England has said that they're going to look through the effect of the low oil price on inflation, pulling those figures down. But, we're still seeing very low inflation. And ultimately, probably, I think the chances are that's going to be a good thing for people.
Yep.
And I think that's going to be a good thing for investors when that feeds through to the consumer economy. And maybe that's the kick that the world's consumer economies need to really step up a gear. But I just think people need to be aware of the risks that lie within that.